I'd like to say hello and welcome to everyone that's joined us for today's MGAA market briefing. So yes, I'm Alison Cairns from the MGAA, and so yes, just do a quick welcome, but also a little bit of housekeeping before our main event. So polite request, please, if you could keep your microphones and cameras off, because it helps us with the technology, minimises the risk of anything going wrong. So that's a nice polite request. One more request is if you are considering activating any AI note-taking tools, if you could refrain from doing so, please, because we don't have the audience's permission. So quick question, or sort of not a question, quick a couple of bits about the actual presentation, market briefing itself. Lots of opportunity for questions at the end, so please can I ask that you pop your questions into the chat and we will cover them. So yeah, don't wait to the end, pop them in as the question comes to mind, and we will cover them off at the end. Also to let you know that our market briefings are accredited by the CRI for their content and quality. And so, yes, if this does align with your development plan, then you can put the time spent on the webinar into your CPD. So I think that covers everything from me. It's just a case of introducing and thanking our presenters for joining us. So we can see them on the screen there. We've got James Cooper and Mark. I'm try very hard to get this right. Beswick. From Clyde & Co. Thank you. I've tried before and failed, so apologies. So they're joining us from Clyde & Co, and they're going to present on exposures for directors and officers. So without any further delay, I will hand over to you two to introduce yourselves and share the presentation.
Many thanks. So my name is James Cooper, and I'm joined by Mark Beswetherick, who is a partner also in the FI D&O team. We both have a lot of experience in defending directors and officers in relation to multiple claims, or multiple types of claims that arise against them, both in this country and then also with a lot of experience monitoring stuff abroad as well. So what we're going to be talking about today is the outcome of our annual D&O survey that we've done with Willis Towers Watson now for the last sort of 4 or 5 years. So if we can bounce on one slide, please. What this survey looks at is the key risks which are impacting on boardrooms today, but more importantly, how directors and officers are responding, but also trying to understand what they see as their own personal risk. So first of all, we're going to look at the overall top 7 list, and then we're going to look at a couple of the topics that arise from that in a little bit more detail. So if we can bounce on Gareth. One more. So what this does, it sets out where the majority or how the split of the people who filled in the survey come from. So you can see that it does cross pretty much every ocean of the country. Biggest response comes from Europe, followed by Asia and LATAM, then North America and Great Britain. So next slide, please. So what we've set out here is the top 7 risks which are looked at globally across all sizes of business and across all regions. So it's putting everything together into one risk survey. And there you can see the last 4 years as well. And the headline point that comes out of this is that health and safety remains the top concern for directors and officers. 80% of respondents considered it a very or an extremely important concern for them. When you look at it by company size, health and safety tops the list for all but the largest companies. They rank regulatory breach as their biggest concern. I think that probably reflects the increased focus by regulators and also the heavy regulatory burden for large companies. Health and safety is in 5th place for them. I should say that if you look on our website, if you look on the Willis Towers Watson website, you'll see a lot more detail. We've got lots of sort of knowledge management around the survey. It also sets out in much more detail by region, by company size, etc. So please do look on those websites to see a little bit more detail. Now, the reason why health and safety is again the leading concern isn't precisely clear. There's clearly a number of high-profile cases in this jurisdiction with some very high fines being imposed, but also the Health and Safety Executive in the UK is one of the most effective regulators. It has a 92% conviction rate for all of the prosecutions that it brings. It isn't though just this jurisdiction. In Australia, industrial manslaughter has now been introduced across all states and territories. There's also a number of workplace legislative reforms that came into effect in 2024 as well. And I think when you look across the globe, there's no doubt that the COVID pandemic highlighted the importance of having healthy employees, so that greater focus upon health and safety. And there's a growing willingness by boards to accept that mental health is as important as physical health, and a recognition that companies that look after their employees, that they lead on that well-being issue and have greater productivity and usually improve financial performance. Now, whilst the health and safety concern numbers have reduced slightly on last year, down 4%, what you see across the whole top 7 is that social risks now feature prominently in that list of concerns. And when you look over the 5-year period, the increase in concern is noticeable. So, for example, breach of human rights within or by business operations has risen from 23% of respondents in 2021 to 62% in 2025. And in several regions, it even gets into the top 7 risks. Similarly, concern about supplier business practices has risen from 27% in 2021 to 59% in 2025. Now, why is that? Why have these social risks climbed the ladder over this period? I think our view is it's now accepted that by integrating these social risk considerations into the thinking of the board, then directors are better able to position their companies for growth and resilience in that ever-evolving business landscape. Clearly, there's been a number of studies as well that have concluded that responsible social practices do result in a better financial performance by those companies who take it seriously. Now, failure to properly embed social risks can lead to a number of exposures. And I think it's not just the legal liability that we'll touch upon later, but also it alienates consumers, employees and investors. All of those stakeholder groups are now increasingly socially conscious in many, many jurisdictions around the world. Those companies that don't take this seriously are finding it harder to attract and retain investment. There's reputational damage that can fall off the back of not taking this seriously, supply chain disruption, to delays and increased costs, possible increased labour disputes, high turnover. There's also potentially huge knock-on effects, not only for the company and its workforce, but also in broader communities and economies in which companies operate. And boards really do need to fully understand all of this before acting, or it could bear the brunt of claims arising from the mishandling of corporate and social responsibility policies. Obviously made significantly harder by the political landscape in certain jurisdictions where actually this concept of social risk has perhaps moved in a different direction, one that we were not perhaps expecting. And so boards which are operating across different jurisdictions are now having to balance the need for corporate and social responsibility policies which play to one government, one part of society, versus corporate and social responsibility policies which may need to be run in different jurisdictions. Now, increasingly, despite the global focus on corporate social responsibility and the E of ESG being such a hugely important topic, climate change hasn't featured in the top 7 risks this year for any region or industry. It's dropped away completely from its number 1 spot in the survey in the UK in 2023. But it is clear that any disclosure requirements can create liability, and the potential for greenwashing litigation is gaining momentum. This idea of disclosing climate change exposure, the rules, particularly in the financial services arena around greenwashing, do really, I think, lead to a slight concern that perhaps this focus or this lack of focus now around ESG or the E in ESG could lead to greater liability down the train. It's slightly worrying that it has fallen away to such an extent as these new disclosure rules come in, as the new financial services selling rules around greenwashing have also now been embedded within the legislation in this jurisdiction and also particularly across Europe. Now, concern about data loss comes in at second place. It's swapped positions since last year with the concern about cyber risk. Both of those concerns have remained fairly steady, though, across the last 5 years. They've only really moved by a couple of percent here and there. It's no surprise that they remain near the top. Obviously, we see significant costs that can flow from data loss. Data loss is often, but not always, linked to a cyber event. So leaving stuff on public transport, for instance, improper disposal of sensitive information, physical theft, etc., is as much a data loss as a cyber attack. And if you needed any more examples than just seeing the issues that the Marks and Spencer's board is having to deal with at the moment for the last couple of weeks, I think really shows you how vitally important having a clear-eyed focus on cyber risk is. Regulatory and legislative frameworks in the cyber arena are constantly evolving. So we have the Data Use and Access Bill in the UK currently progressing through Parliament. That's seeking to make changes to the GDPR and the Data Protection Act of 2018. The Cyber Security and Resilience Bill is also set to become law. They're both going to increase the regulators' enforcement powers and place a burden on D&Os to get data management and cybersecurity right. It's not just the UK, of course. In Australia, there's long-awaited reforms to the Privacy Act. That now has a statutory tort for serious invasion of privacy. In the US, we're starting to see a real drive around group actions for those who have lost data in a cyber attack. That has become sort of one of the new battlegrounds for redress claims. In the UK, the German Federal Court of Justice has recently determined that a simple temporary loss of control over personal data that results from a GDPR breach can be considered non-material damage, warranting a compensatory award even if there is no direct misuse of the data to the detriment of the individual. That can embolden group claims across the EU. Shareholder actions also possible. In Australia, for instance, shareholder class action was brought in 2023 following a data breach that saw an 18% share price drop. Maybe not quite as many shareholder class actions in the US arising from cyber attacks, but there are a number. It's maybe just that they haven't evolved in quite the way that we thought they would do. If we move a little bit further down, we can see fifth on that top 7 risk are risks deriving from systems and control failures. That's a new entry into the top 7 from last year. It is clearly manifest that failures in this regard often provide the foundation and launchpad for numbers of exposures for companies. Criminal proceedings due to inadequate financial crime controls, for instance, civil actions such as shareholder class actions, but probably most importantly, significant regulatory fines for breaches, which could have been prevented by the implementation of robust controls. So a vitally important area for directors and officers, and again, I think quite heartening that they see that as one of the top 7 risks that faces them. Regulatory risk more generally continues to be a concern. We can see it here at number 4 in the global risks, and again, with good reason. The regulatory landscape is complex. Range of new rules and regulations are continually being introduced. No matter whether or not a company exists in what they would see as a regulated sector, such as financial services, regulators do touch upon every part of the real economy. So I talked about health and safety earlier. The health and safety executive is a regulator, and it applies to every single company in this jurisdiction. We see a new entry at number 6 on the top 7 list. That's the risk of civil litigation. It's crept 1 spot above bribery and corruption and has therefore knocked breach of sanctions out of the top 7. Breach of sanctions is still high overall, but when you look at the split by company size and region, the concern is largely felt by Ds and Os in the largest companies in Europe and the UK. That's obviously to be expected. I think, though, that it is interesting, and we'll come back to civil litigation a little bit later, because it is certainly an evolving area, is that civil litigation. We see, and I've talked about shareholder class actions, but we see mass redress now in the competition arena in this jurisdiction, huge product liability claims in many, many different jurisdictions around the world. And just that worry about civil litigation, driven a lot by litigation funding, plaintiff law firms, etc., is pushing that risk further and further up the risk register. And then rounding off the top 7 list is the concern about bribery and corruption. It has made the list, but the concern is felt very much more in the largest of companies. So in companies with revenue over $5 billion, 81% of respondents said it was one of their top risks. That compares with 51% of responders in companies with revenue below $50 million. Many reasons for this, but it's really primarily driven by operating across many different jurisdictions rather than just one that the smaller companies do, and that need to try to navigate different regulatory landscapes and also sometimes different types of culture in some of these emerging jurisdictions in which they seek to operate. I think large companies can also come under greater regulatory and public scrutiny. Scandals can lead to significant penalties and large civil actions. We've seen that a number of times in this jurisdiction across Europe and in particular in Australia and the US. Now, whilst it isn't a top 7 risk, I did want to highlight that only the 2 smallest categories of companies, so those with less than $50 million in revenue, are concerned about insolvency. Mark's going to talk about insolvency in a little bit more detail later, but whilst it is true that SMEs are quicker to fail, large companies are certainly not impervious to the risk of failing and the consequences that can follow for Ds and Os. And we'll look at the stats a little bit later, but the stats for company insolvencies in the UK remain at a historic high. Small drop-off since last year, but still very much higher than the pre-COVID period. We have, I think, noted in the last few surveys that there is a bit of a disconnect between perceived risk and actual risk of Ds and Os, and that, I think, especially comes forward in this insolvency-related arena, because so many claims that come on to or are brought against directors and officers arise out of insolvency. It is, we feel, one of the most important risks, but it's perhaps not surprising that it isn't seen in the top 7 by many of the larger companies, because, as you would expect, boards are generally much more positive about the prospects for their companies than perhaps one would expect when you look at the whole of the economy across the board. But I think what that list of top 7 risks does reveal is the various difficulties and challenges that boards encounter and the serious implications for them. We'll touch as we go forward on some of the more sort of important I'm going to have Mark now talk about the regulatory piece.
Sorry about that, I just got reception for a moment. Morning, everyone. So on the regulatory side, 74% of the responders, if we can just move on to the next slide. The one after this one. The next one, I think. Yeah, sorry. Yeah, 74% of responders to the recent survey ranked regulatory breach as a very or extremely important concern for D&Os, placing it at number 4 on the overall top 7 list. So it topped the concern list for the largest companies, that's those with over $5 billion in annual revenue, and featured high on the top 7 list when viewed both by region and by industry. Concern among D&Os about regulatory breaches is not a surprise, given the constantly changing regulatory landscape, which requires directors to stay informed and to actively seek to make their companies compliant with a very complex range of regulations. This is a particular challenge for companies operating in multiple jurisdictions, especially since the general rise in regulatory actions in the wake of the global financial crisis, with often substantial financial penalties being imposed for companies and their directors and officers. Regulatory risk has consistently ranked 3rd or 4th in the top 7 risk list from 2018 up to 2025, which highlights its ongoing importance in the risk landscape for D&Os. The regulatory landscape is heavily influenced by the political landscape, with notable changes in the past year, particularly in the US and the UK, and it's estimated that nearly half of the global population live in countries where there will be elections in 2024 or will be elections held in 2025. Turning then to consider the US first, Trump's second term is already bringing significant deregulation, reversing many of Biden's changes. This could boost short-term business growth, but raises concerns about long-term corruption risks and financial stability. Trump's deregulation strategy is aided by the change in leadership at the SEC, from Gary Gensler's proactive and stringent approach to Paul Atkins' more conservative approach. Trump is also replacing the leadership of most federal agencies, which will put an end to many regulatory projects that were once in the pipeline. And following the Supreme Court's decision in June 2024 to strike down the Chevron doctrine, which previously granted agencies discretion in interpreting ambiguous statutes, the administration may find it easier to roll back existing regulations. So this deregulation strategy, aided by the new Department of Government Efficiency, or DOGE, which at least initially was co-led by Elon Musk and Vivek Ramaswamy, involves cutting resources for regulators. This will likely reduce their ability to pursue actions and marks a shift from the recent broken windows approach, where even the smallest infractions were pursued. Trump also recently signed an executive order pausing the enforcement of the Foreign Corrupt Practices Act, or FCPA, which US regulators have aggressively enforced around the world. Since its enactment in 1977, FCPA enforcement investigations and actions have resulted in substantial exposures, which range from sizable attorney's fees, significant fines, as well as follow-on shareholder litigation, to companies, their D&Os, and their D&O insurers. And according to a White House fact sheet, the pause on FCPA enforcement allows our country to compete with other nations on a very level playing field, and should promote American competitiveness and efficient use of federal law enforcement resources. However, that pause should not be taken as meaning that firms should deprioritize anti-corruption measures. As an initial matter, criminal FCPA and FEPA violations are subject to a 5-year statute of limitations, which can be extended up to 8 if foreign legal assistance is required, suspended with tolling agreements, or extended using a conspiracy charge. So the Department of Justice of the next US administration, which will begin in January 2029, could re-examine allegations that were deprioritized under the executive order and new enforcement guidelines, insofar as any limitation periods have not yet lapsed by that time. Regulators are likely to, as was the case during the last Trump administration, follow a more basic agenda, pursuing traditional actions relating to fraud, illegal trading, and market manipulation, rather than pursuing actions deriving from newer risks, such as ESG. In that regard, we've already seen, for example, that Trump has withdrawn the US from the Paris Agreement on climate change, paused funding for green industries, and rolled back the SEC's climate change-related disclosure rules. Many other initiatives around ESG have also been put out to pasture. Trump's actions added to a growing anti-ESG sentiment in certain parts of the US, which has led to some US companies downplaying ESG initiatives, which is also known as greenwashing, and DEI programs, and asset managers becoming more reluctant to support activist shareholders or assist on social and environmental issues. It's worth noting, however, that initiatives will continue at the state level. In summary on ESG, there's a complex web of current and upcoming rules and regulations at both the state and federal levels applicable to ESG, which creates a difficult environment for most companies and their D&Os to operate in, particularly while investors, regulators, and plaintiff lawyers are closely scrutinizing ESG disclosures by financial institutions and other types of companies. So overall, Trump's deregulation plan is likely to result in a decline in regulatory activity at the federal level, but we may well see individual states who have their own regulators stepping up to fill that void. In addition, activist investors and plaintiffs bar are unlikely to slow down in relation to civil actions, so companies and the directors should not become too complacent. Turning to the UK, the desire for growth is also impacting the regulatory landscape in the UK, although the ethos behind the plans and the execution thereof is different from the US. Following the July 2024 general election, as we know, a new Labour government came to power for the first time since 2010. Chancellor Rachel Reeves' inaugural Mansion House speech in November 2024 outlined reforms designed to boost the UK's financial sector, which built on the Edinburgh reforms that were launched by the last Conservative government in December 2022. On the 17th of March this year, the UK government published a policy paper outlining its plans to enhance regulatory clarity and efficiency, aiming to support economic growth and investment. Key initiatives include streamlining regulatory duties, improving transparency, and introducing reforms across various sectors. The government also intends to simplify the mandates of key regulators to ensure a sharper focus on economic priorities, including in financial services. To this end, on the 25th of March 2025, the FCA published its strategy for 2025 to 2030, which sets out the FCA's vision and priorities that will guide the FCA's future and shape its decisions for the next 5 years, which contains itself 4 priorities, focusing on the themes of being firstly, smarter, more efficient and effective regulator, secondly, supporting economic growth, thirdly, fighting financial crime, and fourthly, helping consumers become more resilient. But the central theme is rebalancing risk to spur growth, plus it needs to work with industry and the government to maintain and improve the FCA's position as a major financial hub and the largest net exporter of financial services. While the reforms aim to boost the economy and the UK's global financial markets, critics argue that regulating for growth might lead to a relaxation of important regulatory safeguards, many of which were put in place after the global financial crisis, potentially therefore increasing financial misconduct, financial instability, and a lack of market confidence. Additionally, there are concerns that reduced scrutiny may lead to oversight gaps and a higher chance of regulatory breaches. The current Bank of England head and former head of the FCA, Andrew Bailey, recently cautioned policymakers in a speech not to forget the lasting damage of the global financial crisis when focusing on growth. This concern is heightened by the new secondary objective for the FCA and PRA to facilitate the UK's international competitiveness and medium to long-term growth while aligning with international standards. This has drawn criticism from some quarters concerned that the objective potentially encourages looser regulation in order to increase that competitiveness. So one can see that balancing stability and competitiveness will be a very difficult exercise for the regulators to achieve. But the FCA has stressed that it will not revert to the light touch regulations seen before the 2008 financial crisis, whilst acknowledging that the trade-offs involved in fostering innovation and economic growth. So as you can see, politics significantly shapes regulatory agendas, influencing policy priorities, legislative changes, appointments and growth objectives, which collectively determine the focus and volume of regulatory actions in companies and their D&Os. Despite the incoming changes in the UK and the US, we don't anticipate, however, a significant change in the concern level for D&Os in future surveys. Regulatory risk has been and will continue to be high on the list of concerns for boards. And just to give a quick flavour for FCA enforcement activity, on the 9th of September 2024, the FCA released its annual report for 2023-24, highlighting its progress and key accomplishments for the past year, along with its enforcement data, detailing the actions taken during this period. The data shows that the total number of enforcement operations opened in 2023-24 was down. The enforcement data shows that fines in 2023-24 dropped significantly. There were 12, down from 24 the previous year, with a total value of 42 million, which was down from 199 million in 22-23. However, the FCA significantly increased its use of cancellation powers, made a number of public censures, and upped its use of early intervention measures and the imposition of non-financial sanctions, with the aim of catching breaches and wrongdoing at an earlier stage. Areas of focus continue to be clamping down on authorised business, unsuitable advice, systems control failings, where significant fines have been handed out in this regard, and also tackling anti-money laundering and financial crime. The FCA's criminal actions in particular are increasing year on year. Of the 188 cases open at the time of publication of this enforcement data, 42 were criminal cases and 44 were dual track, which is investigations which could result in either criminal or civil proceedings. And since April 2023, the FCA has charged 21 individuals with financial crime offences, the highest number of charges it has received in a year. It also brought 9 successful prosecutions against fraudsters. And in 2023, it secured 9 freezing orders, 6 more than in 2022, and restrained over £21 million in assets of individuals under investigation. So a lot going on in the regulatory space. And on that note, I'll pass back to James, who's going to talk a little bit about the litigation risks, civil litigation.
Thanks, Mark. So as I said earlier, civil litigation had entered the overall top 7 risks for the first time, certainly since we started tracking it in 2018, and places at number 6 on the list with 63% of those responding saying it was a very or an extremely important concern. It's been floating around though for the last year or so. It had moved up from 38% in 2023 to 63% last year, and then staying at around the same level, but moving into the top 7 this year. So what's the reason? Well, obviously the litigation risk is always going to be influenced by the industry in which a company exists, its size, the regulatory environment, its business practices, relationships with stakeholders. So in certain sectors like energy, finance, pharmaceutical, you would see that most of those are more prone to litigation due to the nature of their products. And then larger companies also tend to be more susceptible to claims due to the higher public profiles and the large potential reward for claims. Not always the case, of course, because particularly when you talk about relationship with stakeholders, then you can see things like unfair prejudice petitions and being much more prevalent in the SME space than perhaps in the larger company space. There's a number, though, of wider risks which can contribute to that litigation risk across the last couple of years. They include things like social inflation, the spread of class actions and the impact of litigation funding, plaintiff lawyer activism, forum shopping, parent company liability, regulatory activities such as the issues that Mark was just touching on, growing consumer activism and awareness of rights, and then that sort of increasing anti-corporate sentiment and distrust of fat cats that we see around the world at the moment. Drilling down a little bit into just a few of those, social inflation, that's a phrase that we use to refer to the impact of changes such as higher jury awards, sort of more liberal treatments of claims and new concepts of tort and negligence that we're seeing some courts look at. There's just been a decision this morning, for instance, in Germany that looks like it potentially can make more companies liable for climate change type issues. I think our general view is that there's sort of limited risk really around the surge in social inflation outside of the US because of the role of the jury. It's this role of the jury that's been so significant in delivering that sort of social aspect of some of the nuclear verdicts that we're seeing. But that isn't to say that the litigation risk has fallen away with social issues. I just touched on the German decision that came out just this morning. But really, many of the drivers that underpin social inflation in the US exist elsewhere. So advancement of access to litigation funding, group litigation, involvement of activists in claims, general anti-corporate sentiment, influence of social media in particular. And that plaintiff lawyer activism, we're seeing these sort of funded groups really going hand in hand now with plaintiff lawyers, a trend that we're seeing increasingly exported from the US and Australia into the UK and more widely into Europe. It's that sort of proactive plaintiff bar driving both the cost and the volume of liability claims. US plaintiff law firms have been renowned for this for the last number of decades. They've been looking internationally now to identify new liability claims markets. They're very well capitalised. They possess the expertise to pursue very large-scale litigation and collective actions. And I guess most importantly, they're just not conflicted out of actions like so many other firms are in the domestic markets. We're seeing the same coming out of Australia. So there's a number of law firms now that have set up in London, which are Australian law firms with the primary goal of driving large-scale consumer redress in this jurisdiction. Mark's talked about regulatory activity. We talk about regulatory activity all the way through this because it is such an important area. There has been a massive increase in regulatory scrutiny enforcement activity since the global financial crisis in many different jurisdictions, not just in the financial services space, of course. It is, though, being increasingly politicised, as Mark has talked about, has a range of important business and reputational consequences, but it also really complicates and sometimes worsens any related civil claims, which increasingly run in parallel with regulatory actions, particularly outside of the US. So in the UK, for example, it's very common for civil claims to follow regulatory findings. The current motor finance discretionary consumer issue, for example, that's resulted from regulatory scrutiny. In addition, regulatory focus on individual accountability has thrown a spotlight on D&Os and their role in high-profile scandals, and in particular, I think, around insolvencies. And that growing sort of consumer activism and awareness of rights, a lot of it driven by social media. So no doubt many of you have seen on Instagram and things like TikTok, the things around Dieselgate, things around motor finance commissions, and then so many phone calls now that we all receive from these claims management companies, again, really trying to drive up, they say, the awareness of rights, but really driving more money into their coffers and leading to that cost of business significantly increasing. It's far from an exhaustive list of reasons as to why civil litigation is presenting a clearer and heightened risk to companies. But I think what it hopefully does show is that there is a real melting pot of factors that contribute to make it so. And I think the problem, of course, is that by its very nature, a melting pot is very hard to mitigate or plan for, particularly in a world which seems to change almost hour by hour. So I hand back to Mark now, and he's going to pick up around cyber and data loss.
Thanks, James. Just move on to the next slide then. So cyber-related risk remains a top concern for D&Os, as we mentioned earlier. So since 2016, it is featured in the number 1 or 2 spot every year, but it's interesting to note that it's dropped to 3rd place in the latest survey. Nonetheless, it's still high on the list of concerns, and that reflects the ever-changing risk, which is hard for D&Os to keep on top of, combined with an increasingly aggressive regulatory environment, which has led to more proactive enforcement, higher fines and regulatory costs. And just on the slide is a summary there of how claims might arise in the different 3 areas of criminal, regulatory and civil. This is an ever-evolving risk, and with the availability of artificial intelligence tools, cyber threat actors are now beginning to integrate AI into their operations, particularly in reconnaissance and social engineering, and that's according to the latest report by the National Cybersecurity Centre. This, they say, will make such attacks more potent and challenging to detect, and potentially lowers entry barriers for novice criminals, contributing to the overall global ransomware threat. The report notes that 72% of organisations report a rise in cyber risk as attacks become more targeted and harder to defend against, and the NCSC estimates that the projected global cost of cybercrime by 2028 will reach 13.82 trillion, which is a 50% increase since last year as these threats grow more scalable and sophisticated. This is obviously a worrying development and adds further level of pressure on D&Os to implement adequate cybersecurity controls and react efficiently and effectively in the face of an attack. Cyber risk then goes hand in hand with the number 2 concern, data loss, as we've seen recently with Marks and Spencer's troubles. With GDPR having been enforced in Europe for a number of years now, plus reforms regimes in many other jurisdictions, companies and their D&Os have witnessed the significant fines that can be issued by data protection authorities following a breach, and the laws still developing on claims from data subjects. In addition, the first-party costs following a breach can be considerable, and reputational risk is very high. So currently the UK GDPR applies, but a new piece of legislation, the Data Protection and Digital Information Bill, was introduced to Parliament in 2023 and is still making its way through the parliamentary process. While the substance of legislation is not likely to be weakened, it is intended to reduce the administrative burdens and will aim to introduce a bespoke British data protection system. In addition, the government is also seeking to update the Network and Information Systems regulations, which were originally derived from the EU's NIS directive. Changes will aim to boost the security standards and increase the reporting of serious cyber incidents by bringing managed service providers into the scope of regulations and improving incident reporting. Despite these proposed changes in legislation, we would question the extent to which departing from GDPR may actually lighten any existing burdens. There are many organisations in the UK which process personal data in the EU or of EU individuals, and in those circumstances will still be required to comply with both the EU GDPR and the new UK legislation and regulations. So any divergence between the two is likely to increase rather than decrease their data protection obligations. Regulatory actions from financial regulators for cyber systems and controls failures can also be added to that significant risk landscape. In terms of enforcement trends, there is a recognition that material fines are not the only way to sanction controllers, and ensuring GDPR compliance is part of the new ICO's new approach for the UK. In a number of speeches last year, the UK's Information Commissioner, John Edwards, declared a step change in the ICO's enforcement approach. Fines will remain an important regulatory tool, and the ICO will use them in instances where they're truly needed for breaches which have the potential to cause the most harm to people, or where businesses have profited from their non-compliance. But instead, we're seeing a shift towards publishing reprimands. The ICO will publish all reprimands going forward, including reprimands issued from January 2022 onwards, unless there's a good reason not to. What explains the change of approach? Well, it's firstly about accountability, secondly about the rest of the economy needing to know what's happened, the reason for the infringement and what the ICO actually did about it, and thirdly to give organisations certainty in as to what the law requires from them in the future. Whilst there's also growing third-party liability risk in some jurisdictions, the UK data litigation market ground to a halt in the wake of decisions in Lloyd and Google and Warren and DSG, which severely undermined the viability of mass litigation and smaller data breach claims respectively. In particular, the courts are dismissing claims for distress where there was a breach but no real distress or financial loss has been caused. While some smaller cases progressed to trial and several have been referred to county courts, High Court judges have only dealt with a handful of cases since Lloyd and Warren, and all of the opt-out cases have been withdrawn, and cybersecurity breach follow-on claims have struggled to get off the ground. So whatever the risk of regulatory action and third-party claims, a major cyber incident can be an existential threat for any business. And it's relatively easy to see how any failure to take reasonable steps to prevent those attacks or, say, to ensure adequately against the consequences of those attacks can be used to frame a claim against the director for breach of that duty. And on that note, I will pass back to James, who's going to talk on the next topic on bribing, corruption and corporate criminal liability.
Thanks, Mark. So bribing corruption has featured now for the last 4 years, likely reflecting the increase in international cooperation that we see in relation to these types of crimes. There's also been the beginning of a sort of a shift in the way that these crimes are looked at. Increasingly, they're not just prosecuted directly, but also against companies on a failure to prevent basis. That model places the onus on the company to put in place reasonable and adequate procedures to prevent the crime in question, and failing to do so can give rise to liability. In the UK, this criminal liability landscape was expanded by the Economic Crime and Corporate Transparency Act of 2023. That adds to the direct and failure to prevent offences which were contained in the Bribery Act and the Criminal Finances Act. And what it does is it introduces a new corporate offence of failure to prevent fraud. That holds organisations liable if their employees commit a fraudulent act for the organisation's benefit. It applies to large organisations only. It's defined as those meeting at least two of the following criteria: more than 36 million in turnover, more than £18 million balance sheet total, or more than 250 employees. Now, the defence to this offence is proving that you've got a reasonable procedure in place to prevent fraud, or that it was reasonable not to have such procedures in place. Now, whilst it sounds on its face that those prosecutions won't impact Ds and Os, I think it's pretty clear that most or a number of those corporate cases are going to result in a deferred prosecution agreement entered into between the organisation and the prosecuting authority. And DPAs are agreements where the sanctioned entity's prosecution is deferred in exchange for the payment of a fine and on the condition that certain cooperation occurs. And this process not just requires significant cooperation on the part of the corporate entity, but it can include implicating wrongdoing individuals who might then be subject to subsequent prosecutions. So you can also expect more civil claims and civil and criminal prosecutions to be pursued against senior management or associated persons based on these failure to prevent offences. Corporate crime can also lead to significant shareholder actions. About a third of the securities actions that we've seen in the UK so far arise from SFO DPAs or prosecutions, so things like Tesco's, G4S, Serco, Petrofac and Glencore. Indeed, the most recent Section 90A claim to be issued towards the tail end of 2023 was against the betting company Entrain, and it involved the first ever DPA with the UK's Crown Prosecution Service, as distinct from the Serious Fraud Office. We can move to the next slide, please. Just picking up around collective actions now. It's not a top 7 risk on our D&O survey. Class actions, though, are a huge risk for companies and the Ds and Os, so we just wanted to take a little bit of time to look at them. It is worth pointing out that there are risks for directors, even if they're not named in a class or a collective action, because they'll likely be required to give significant evidence at trial, often over many days. And off the back of that, they can suffer really quite significant reputational damage. They can also find themselves subject to regulatory or criminal actions arising from the same conduct. So securities group action claims, they are continuing to rise. Turning first to the UK, they can be brought under common law, but the rise in claims really followed FISMA in 2000, utilising the Section 90 and 90A courses of action. The number of those claims is relatively low when compared to the US and Australia, but definitely accelerating. And so far, the majority of those have also been very large claims against really quite well-known companies. The ones that we do have tend to be event triggered, so where an issue has affected the company and there's been some proven wrongdoing, such as a finding by a regulator or prosecutor, which triggers a stock price drop. The cases so far largely concern bribery, corruption and market manipulation, but there is a recent case against Boohoo, and that arises in relation to alleged mistreatment of workers. A trend we're witnessing is attempts by claimant groups to try to use the representative mechanism for shareholder claims. In our jurisdiction, most shareholder claims need to be brought on an opt-in basis. That means if you want to join the class, you have to take a proactive step. That's distinct to the opt-out basis in the US. The representative mechanism would allow shareholder claims to be brought by way of the opt-out basis. Now, there's been a lot of activity in the courts around that, particularly a case called Wirral and Indivia, where the claimants were looking to try to proceed on a opt-out basis. So far, the court has pushed back on that. They considered that the important question about how you manage claims has to be kept within the discretion of the court. But it is being appealed. First instance decision was upheld by the Court of Appeal in January, but it is probable that there will be continued attempts to try to use that representative process to allow larger classes to move forward. In the US, there's a lot of data that comes out from companies like Cornerstone, which looks at the size of the group of claims, so how many claims are issued, but also the settlement and the percentage settlement based on plaintiff damages. In 2024, new securities class actions increased for the second year in a row to 225, moving up from 215 in 2023. It's the highest number of new claims since 2020. And over the past 10 years, these sort of traditional filings have been filed at a steady and relatively high level. They are more difficult to dismiss than the large number of weaker M&A objection actions that we've also seen filed, particularly in the 2017 to 2020 period. There's also the beginning of AI coming into US class actions. So in 2024, there were 15 AI-related securities class actions in the US. A little bit of good news, though. In Australia, securities actions are continuing to tumble down in the risk rankings. I think that reflects the easing pressure in the space following decreased filings. Only 3 securities class actions were issued in Australia in 2024. And it's not just the number, but there's actually been some successful company defences. That space will continue to mature. A couple of the decisions that I just touched on are being appealed this year. So we may see the dial shift again depending on the outcome of those appeals. But very much that sort of Australia landscape, which was a real hotbed some years ago, is starting to fall away. Maturing so that when those claims do come, they tend to be really quite well-founded claims, but the number is definitely dropping away. And globally, I think what we're seeing is the push out of this mass redress type concept for securities class actions. So across Europe now there is a directive which in particular looks at the way in which mass redress claims are brought. Member states are given the option of opt-in or opt-out. It's been quite slow to be issued or to be rolled out, so we're not seeing a significant increase in claims. But certainly our teams across Europe are suggesting that there is a noticeable shift, and it's expected as that directive starts to be rolled out more successfully across Europe and the litigation funders who are already in the continent and sniffing around as they start to get a bit more interested. Again, they're expecting more securities class actions to arise across the European piece as well. So I'm going to hand back to Mark now, and he's going to pick up the insolvency piece.
Thanks, James. I think this will be the last topic now, given the time pressure. As mentioned earlier, insolvency-related claims are a large source of litigation against directors, though, as we also noted earlier, only the smallest companies consider insolvency-related risks as a top 7 concern in the survey. And we just put a snapshot on the, again, on the slide there about how those claims might arise across the different regulatory, criminal and civil areas. So the risk of claims has increased as insolvencies have rocketed in recent times, following all-time lows during 2020 and the first half of 2021 during lockdown. Further, during difficult economic times, there's a much higher risk of fraudulent, dishonest or wrongful actions. And this could all collectively lead to more actions by insolvency practitioners against D&Os for breaches of insolvency legislation and also their duties to the company, in addition to disqualification proceedings that can be brought. And upon insolvency practitioners in many jurisdictions have a positive duty to investigate and to report to the relevant regulators whether there have been breaches by directors. And this in turn can lead to a range of consequences for those directors, including civil, regulatory and criminal actions. Australia probably has the strictest insolvency trading legislation, where if a company is insolvent, the mere suspicion of insolvency, whether objectively or subjectively, is sufficient to create a duty on directors to prevent the company from trading whilst insolvent. Other jurisdictions require an element of negligence in the breach of the relevant insolvent trading duty. In the UK, for example, the Insolvency Service has always actively pursued disqualification proceedings. However, these actions have increased in recent years, in part due to new powers given to them to investigate directors under the simply titled Ratings, Coronavirus and Directors Court Disqualification Dissolved Companies Act 2021. This act aims to prevent companies from evading their debts by dissolving and reforming under new names, but with the same purpose and same assets. And in particular, the government has been keen when drafting the legislation to ensure that the act of dissolution does not allow the companies to avoid repaying government loans that were given during the pandemic, such as the bounce back loan scheme. There is evidence in the statistics that the Insolvency Service is aggressively pursuing directors to abuse COVID-19 financial support schemes. 658 of the 870 directors' disqualifications for 24-25 included an allegation relating to COVID-19 financial scheme report abuse, and that they're pushing for longer periods of disqualification than we've seen in previous years. The average length of time of disqualification is now 9.3 years, which is up from 5 years, 10 months in 2021-22. The Insolvency Service also pursues criminal proceedings. We don't yet have the data for 24-25, but in the previous 23-24 period, the Insolvency Service pursued 22 prosecutions against directors. The Insolvency Service can also bring compensation orders against directors. Compensation orders aim to make the directors financially accountable for the consequences of their unfit conduct. And in the 2023-24 period, 90 directors received compensation orders or provided a compensation undertaking, which resulted in payments in the aggregate of nearly £2.8 million. And there may also, in addition to that, be sector regulatory actions. For example, as we mentioned earlier, the FCA will often use its regulatory powers, including enforcement actions, to pursue misconduct by firms or their directors and officers and senior managers when appropriate as well. So there's a lot of different angles from which people may be pursued in the context of insolvencies there as well. I think on that note, with just a couple of minutes left, I think we're going to pause there and see if anyone's got any questions, if anyone's come in the chat, or if anyone has any further questions they'd like to ask now.
Oh, sorry, just had a bit of difficulty getting back on there. There isn't any questions in the chat, but we've got 3 minutes, so I'll have a very quick question for you. How do you see that the responses in the survey might change in 2026? So what lies ahead, do you think?
A lot of it, I think, will be driven by politics, and therefore how ESG moves up or down, I think, will be determined a bit by politics. I think we would expect AI to start showing its face a little bit. So, as I said, there are now a number of securities class actions in the US around AI, and we are expecting claims to arise. But I think, as Mark touched on in and around the insolvency, that really is where we see most claims against directors in this country. So I think we would expect, if the headwinds in the economy continue, albeit, as I understand it, notwithstanding our sclerotic growth, we are the fastest growing G7 country at the moment at 1.2%. If the economic headwinds continue and more insolvencies come through, then we would expect that maybe to appear on the list. The interesting thing I think about insolvencies is they likely give rise to D&O claims somewhere around usually 2 to 3 years after the insolvency event. So we would start to expect to see more insolvency related D&O claims coming through, particularly around the disqualification process, if the liquidators or insolvency practitioners are seeing issues with the way in which the directors have been acting pre-insolvency.
And I would agree with that. The only thing I would add is that you might expect the cybersecurity and data loss to come back up. I think the survey was done before Marks & Spencer's and a couple of other high-profile examples, so we might see that one raising back up to 1 and 2, particularly with all the AI challenges of the landscape. I think it's dropped off the top for now, but it's likely to come back on. Particularly, it will be on everyone's radars as they see how M&S and other companies are really struggling at board level to deal with these issues.
Thank you. It's been really insightful presentation. Gave us a lot more of the information that sits behind the survey. So thank you very much to Mark and James for their time and sharing their knowledge with us. Just a quick ask of the people who've joined us today. I've popped a link to the survey in the chat, which would be really helpful if you could share your feedback on this session and or market briefings in general, and also just to let you know, the session will be I'll quickly edit the recording and share it with you together with the slides and the contact details for Mark and James are on the slide. So if there are any questions you had but you didn't pop them in the chat, you will have the contact details when the details come out to you, hopefully early next week. So thank you for everyone for joining, and thank you again, Mark and James.
Thank you very much.
Thanks everyone. Bye bye.
Bye bye.